broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. We've reached the appointed time. Thank you for being with us today. And good morning to our friends in Queensland. Good afternoon to the rest of Australia and to our friends across the ditch in New Zealand. Great to have you with us, folks. Please, any of you, just type into the question box. Let me know you can hear me. Let me know the sound volume's all right for you. Good, Mark, on the job. Wow, and Adrian. Flash, instant reaction. You're great guys. Terrific to have you with us. It's a beautiful day at the Gold Coast. It's sunny and bright, and sky's blue, and the ocean's blue, and it all looks pretty fantastic. So, and Jeremy's with us in the UK as well. Great to have you, Jeremy. It's probably cold and miserable over there, is it? Adrian's down in Adelaide. Good to have you with us. Andrew, Albert, of course, he's a tutorial guy. Webby, good to have you with us. King of the Black Lines. Boy, he's been a Daniel Code stalwart. He's been with us a long time, done the tutorial a long time ago. Hank, down in the Hunter Valley. Hope you're well. Hope you got some, I know you've got a bit of rain. Chen, nice to have you with us. John, Juan, there's Justin, that's Hank's son. Mark's doing a tutorial. The other Mark's done a tutorial. Mick D has arrived. I thought you'd be working today, mate. You don't seem to spend a lot of time with us on tutorials because I know you're a hard-working man. But it's good to have Mick with us. He's a new tutorial guy. I've actually known Mick for probably 25 years or more. He was dabbling at the Daniel Code a few years ago, but he decided to take it seriously and do the Daniel Code tutorial, and he's very thrilled with it and doing great. Mike, the Murph over there, good to have you with us. Milton, of course. Yeah, good crowd today. Peter, Randall, Tom up in Vale. He's a builder up in Vale. And the snowy country up there in the States. Beautiful, beautiful part of the world. Anyway, great to have you all with us, folks. I hope you're going to enjoy today. It's we're going to look at markets a little bit in detail, and I'm going to show you the new... Look at Mick, started at 5 a.m. to get here on time. You're a stalwart, mate. I started at 5 a.m. to get this... get this webinar organised. Anyway, it's going to be interesting today. I'm going to show you some interesting stuff, and we have a very, very sophisticated trading program, which I've been talking to you about for probably 2.5. Look, it might even be 3.5 years by now. It's taken an age, but we've got some really, really savvy people who've done that for us, and I'm going to show you the output of that today, and it's really interesting. You're going to abuse yourself of lots of ideas you had and get a whole lot of new ideas as well. Anyway, let's get started here, let's see what the Daniel Code has in store for us today. Those of you who are new to us will not know, but it's a fact. Markets are rational, orderly, and sometimes even predictable. And the Daniel Code controls all of that. Here's a funny page for you called Needham's Heresy. These are some of the things I believe in. If you know how to trade the Daniel Code, you can make more money trading futures than any other legal pursuit. There is, in my view, there is no such thing as over-trading. Remember, those of you who've taken advice from other people or done other courses, they'll all say, that's just 3 trades a month. That's as many as you want. Any more than that's over trading. That's not so. What they're really saying is that they can only spot those setups occasionally, and it's not true. There is no such thing as over trading if you're capable of determining the trend on a very, very fast basis. Price signals alone are ambiguous. So you add the DC numbers to that, that brings us certainty of the trade. Now, the way we trade, we use daily bars. We don't use live data. We don't need to look at intraday data, you can put your orders on, go away and play golf, or go for a drive, or go to the races, or whatever it is you like to do. The Daniel Code trading will not take over the whole of your life. And if you're not paying for daily data, it's cheap, efficient, and stress-free. It is the ultimate lifestyle, as I can tell you. After many years, probably 25 years of being a practicing attorney in Australia, and another 20 years of being a professional company director, managing director, etc., public companies. This is a much, much better lifestyle, I can assure you. One of the things I want to talk to you about today are inside and outside bars. Inside bars, I'm sure most people know this, but just to be clear, they have a lower high and a higher low than the previous bar. In other words, the whole of the inside bar is contained inside the previous bar. Outside bars have a higher high and a lower low, and then they are outside. The whole of that bar is outside the previous bar. Inside bars and outside bars, they're vibrations of time, and they're very, very important. They're part of the market's internal mechanism for adjusting its internal time clock. All markets have their own internal timekeeping mechanism. It doesn't seem logical to us, and it varies between sequences quite dramatically. But basically, think of inside bars as a null or a void. They're like running on the spot, or marching on the spot if you're in the military. There's action, but there's no there's no thrust, there's no go forward on it. So you're running on the spot. There's plenty of activity, but you're not changing your visible position in space or time. And inside bars are part of the market's mechanism when it thinks that it's too far ahead of time. It's run ahead of its own internal time clock. It will put in inside bars to get back to where it thinks its right time settings are. Outside bars, of course, are the opposite of that. You can think of outside bars as either 2 daily bars, or 1.5, or 1.29. It's more than a daily bar. In other words, it's catching up time. When a market thinks it's behind in time, it puts in outside bars to try and catch up on time. I know that's a hard concept, but interestingly enough, whilst we say from a trading point of view, we treat inside bars as null or void. In other words, if we have a signal on an inside bar, there isn't any. So what we say is you simply carry forward the last valid signal you had, which will be the signal on the bar the day before the inside bar, or the last bar that is not itself an inside bar. So we say that's a null or a void, but quite contrary to that idea, inside bars and outside bars are vitally important in forecasting. All of our fourth seal and fifth seal lines and calculations include inside bars and outside bars, and some of them are quite spectacular. I don't think we'll have time today to show you some of that, but I certainly will at our next webinar. This is a sugar chart I'm going to show you. It's a fairly horrible piece of chart. Just let me make sure your pages are changing as mine do, because we're a long way away from each other, and it takes a while for the change I make to work through to you. This is a very, very random piece of chart. I just chose it because it was at random, and it's not even a particularly pretty chart, I can tell you. But from September 21st, 18 to March the 14th, 19 in sugar, that's 121 trading days. 25 of them were inside bars. inside bars. I've repeated that, probably because I want you to be sure of that. And there were, no, it's a typo. In that period, there were 7 outside bars. So these things happen with a pretty high degree of frequency, as you can see. So here's the chart that's going to change for you now. You'll be able to see it shortly. Excuse me. And, you know, it's a pretty horrible piece of chart. It's got one great big run at the beginning. That's nice. Strong low, good high. And then it doesn't sort of know what it's going to do for quite a while. It wanders down, sort of broken up patterns, and wanders around. So let's look what happens with what these inside bars and outside bars are doing. This is first of all looking at inside bars. Now, the lines on the chart are Daniel Code time cycles. And the most prominent time cycles that we use are 44, 59, 62, and 70. 44, 59, and 62 come straight out of the Daniel Code matrix. 70 we call the heathen time. There's nothing heathen about it at all. It just means it comes from a different part of the book of Daniel. But it's, interestingly enough, it's the number that Sir Isaac Newton used in his time analysis of the Bible. As he says, you can argue with Sir Isaac if you like, this is the most important, Daniel's the most important book in the Bible because it foretells the coming of the Messiah. Now that's Sir Isaac Newton's take on things. I don't actually agree with the way he's used his time cycles. It's not how I use them, but far be it for me to argue with such an illustrious character. But 44 is the base cycle for gold. 59 generally gives you highs. 62 generally gives you lows. 70 is a floater between highs and lows. All of these markets can invert. All of these time cycles can give you highs instead of lows. But 70 has particular affinity for anything European. It's very, very good on the euro. It's very, very good on the DAX. So bear that in mind. So what we've done here is we've just started our count. The blue line on the left of the screen is where we're starting these time cycles from. And you can see that this gives you the low on the 62 days. And it also, the 70, straight afterwards, gives you the high plus or minus 1 period. All of this stuff is valid. Time cycles are valid for 1 period, plus or minus 1 period. And it doesn't matter whether you're working this on 12-day charts, 6-day charts, or even daily charts. It has the same variance of plus or minus 1 period only. So it's extremely accurate. So let's move on to the next one, and you'll see we've moved when your chart changes, you'll see that we've moved the start of our count now. It's now starting from an inside bar the day after the high. And from this, what it's given us is the rally low in February on the 62 was a low, and 70 gave us the minor high. And it's a very ordinary looking piece of chart, but it's just as accurate. It's just sticking to these ratios all the time. Now we've moved the starting count down to another inside bar that's after the high, and you can see from here that the 70 is now giving you the low at the end of February, early March, and the 44 is giving you 1 bar from a small high that does very little. You just get a 3-bar counter trend, because there's nothing in trading time that speaks to quantum. What time cycles do is they give you vibrations, and if the other conditions are right, you'll get turns. So I think there's one more before we can try to tell you what this is all proving. So here's a new inside bar. This happens to be October the 17th, 2018, and that inside bar gives you the final high of this move on February the 20th on the 70, it nails that particularly right. Some of these highs and lows, I haven't put all of them on so it doesn't bore you to death, but some of them will have more than one time cycle on them. In other words, as we saw, maybe not at the last webinar, the one before, you'll recall when we were looking at when there was plenty of drama in the S&Ps, we were finding those highs and lows on the 70, then the 62, then the 59, all the same bar. As the cycles moved through, we were finding these important points with multiple time cycles on them. And that's something really to bear in mind. Mick, I know you're the king of the time cycles. Something you really need to look at and understand. And here's, I think this is probably the last one in this series. We get the high, the ultimate high, which comes from an inside bar on December the 14th, 2018. So if all of these time cycles are related through one of these Daniel code numbers, 44, 59, 62, or 70, if they are all related to an inside bar, then it must mean that the inside bars that are setting them up have the same relationship to each other. And that means that these markets are predicting major turns, 44, 59, 62, and 70 trading days in advance of when they occur. So inside days are very, very important for market timing. And there's obviously one more here. This is showing you we got the final low just a week or so ago. And that came from an inside bar of December the 10th, 2018. So have a look at this. Do it for yourselves. Those of you who subscribe to the website Membership Pro, you have this tool. If not, if you don't have that, it's easy enough for all of you to make it up. The software is pretty well available anywhere. And if you want more detail on these numbers, there are two articles on the Daniel Code website. One is called Masterclass 1, it's about time, and the other one's called Masterclass 2, Timing Gold. They're very lengthy articles. They're available on the Daniel Code website. They're free, of course. You should, if you're interested in timing and how it works, you should start with those articles. So the point I'm trying to make to you here is if every significant high and low is coming at a known period, and there's only 44, 59, 62, and 70, a known period from an inside bar, then it must mean that these inside bars are occurring in the same frequency. There is a given frequency that they are creating, so they are got the timing cycles right for future highs and future lows. The more you think about that, the more you'll be amazed, and the more you'll scratch your brain thinking, how can I use that? So I encourage you in that pursuit. Let's have a look at this next chart. This is natural gas. And those of you who don't trade natural gas, we saw this enormous blow-off in late November, early December 18. And what actually happened here is that there was a very, very big short position, mainly in options, but also backed up in futures, which the market or some smarty found out about. And this is actually a forced liquidation. These bars are absolutely massive. This price movement is just huge. And what this was the market, or some parts of the market, were forcing a liquidation by the holder of the short position. And eventually, once they got his position completely wiped out, the market started to go down. But if you look at the size of these bars relative to the other bars in natural gas, you are never, ever going to see anything this size, certainly nothing bigger, and I don't know how far you'd have to go back in time to find bars of this sort of size. But the whole point of it is that even though this was a totally artificial forced liquidation, look what you got. Your 59 gave you 1 bar from the high. In other words, plus or minus 1 period again. No matter how wild and woolly the markets get, they may appear that these are random events, in this case the forced liquidation of a very, very big short position, but in fact it all happens in the same time sequences all the time. This 59 period, that's 1 period from the high, just comes from a standard little low back in late August, end of August, early September. So think about that stuff because it's important to your trading. So this next chart I'm showing you is coffee, and this is the 6 Seal, 6S as we call it, which we're releasing to you on this weekend. In fact, you've had it for 5 months. We've been running it in a trial version for 5 months, so you've seen all those 6S signals, and those of you who've been interested and are very interested in them, we're releasing that on this weekend. Have a look at this chart because I want to just show you a couple of points that we're working towards. This is pretty simple and straightforward, and this one is showing you the some of the difficulties we get into around outside bars. You can see that the second buy leads you into an outside bar. The third buy on this sheet leads you into an outside bar. And a lot of you are having trouble with outside bars, and I understand why. Outside bars, for some reason, seem to pose a difficulty to charting programs. If you're running a trading program, for example, on Trade Navigator, it can't trade the stop and reverse on an outside bar. In other words, those of you who've been with us for a while know that if we've got a buy signal, let's look at the main buy signal in March, the 17th, 18th, around there, little buy signal that fails because every signal has an entry point and it has a failure point. And what happens with the outside bar is it elects the buy and then it reverses and goes down and takes out the low of the setup bar. And that's your failure point. And at that point, you should stop and reverse and go short. And that applies to all outside bars. However, what happens in there is you lose the value, entire value of a whole day's trading, the day prior to the outside bar, because you go long at the high of this bar and you're short at the close of this bar. And this is a fairly substantial bar. You lose considerable amount of money doing that. So we not only have that problem, this just shows you where the problem bars are. We not only have that problem with outside bars, we also have that problem with setups that are trying to change the trend but fail to change the trend. Excuse me. And how we deal with that in success is if we think we're against the trend, we use a smaller risk margin than we would if we think we're with the trend. And it's very, very accurate. It's not very often that we get. This is one right here. Here's an example. This is coffee, which on March the 18th gave you a trend change signal that changed the trend to up, and the next day, bam, it slams down and slaps the trend back down to trend down. That doesn't happen very often. We've been trading this success for you for over 5 months. We started mid-late August, I think. So we've been trading it for over 5 months, 11 markets. 5 months, 22 trading days in a month is 100 and something times 11, so there's at least 1100, probably closer to 1500 signals we've created. And this immediate slam back against a trend change signal has only happened about 4 times out of, say, 1100. It doesn't happen very often, but it does happen, and it's expensive because that's a lot. And what we're working towards telling you is that we're developing a way to avoid that. Particularly Justin down there in the Hunter Valley. I know you'll be interested in that. So just looking at these 3 here, look, it's not the end of the world, but you can just see, just on those 3 examples, you've got a loss of $1,500. And this is called, the new system we'll get to you in the next month or so, is called 6S the One Way. In other words, we'll give you a program that will only take trades with the apparent trend. When it's against the apparent trend, you'll simply have a stop loss which will stop you out at the position where a valid reversal signal would be elected. So what we have now is 6S. We call it the everyday. We give you a signal for every day and the stops that go with it, and we'll be developing 6S the One Way. So I just wanted to tell you that we're aware of the difficulty some of you have. Justin's been talking to me about this for a while, and we can come up with a program that will get rid of, not entirely, but will get rid of the majority of these outside bars and these fake trend change bars. Now, everything you do in trading has a price. Bit like life, isn't it? Whatever you do has a cost, and the cost to this 6S the One Way is going to be that you're going to miss the big snapback reversal bars. But the reality is they don't happen very often. They have an outsized effect on your psyche. I've been looking at this for years, but I keep saying to myself, oh, you'll miss the big snapback bars. They don't happen that often. So, you know, if you were to miss those, they would well be overcompensated for what you'd be saving by avoiding potential outside bars and the 1 bar counter trend. Same thing, they're very damaging to your trading. In fact, there's a method to overcome even that. We've got some data, which I think I've shown you before, which is the opposite of what we all think about trading, that we're always very concerned to get into the trade early as possible. People who are short-term traders and day traders who are trading really, really fast time frames are saying, you know, you can't trade daily bars because you can't get in early enough, and I can get in on a 5-minute bar and a 10-minute bar. I can actually show you some data that if you run it over 7 years or more, running data off short-term data packs doesn't really tell you much, but you start running it over really long periods of time. There is a mathematical argument to say that putting your stops much, much further away, these are stops on entry, putting your entry position much, much further away from the market than you can possibly imagine is a profitable strategy. And it's profitable because what you finish up doing is you're only buying or selling the bars that have really big momentum. And statistically, the charts, the bars that have really, really big momentum, and I'm talking something like 40 to 85 ticks past where you'd normally have your entry point. Statistically, bars that have really, really big momentum, when elected, they have a huge propensity to close with a profit, something in that 97, 98 to 100%. Some of you have seen that on Fractalian, but if you're interested, I'll be happy to show it to you next time we do a webinar. So I'm going to show you some fairly extensive results, and I should have got some long, lengthy wording here that I've got from Concept 2, and I've failed to acknowledge them, so I apologize for that. And basically, what it says is that the program that's creating the results for us is a SIM account. It's running, because we trade so many markets, it's running SIM accounts, virtual accounts, on all these markets. And there are all sorts of limitations to that. With our program, we have commission is included, $2.50 a side, which is more than you should be paying, but slippage is not accounted for. I think our sim trading accounts are better than any others I've seen, because the people who designed it have been extremely diligent, and in fact the way they've designed it, we take 3 price snapshots every day during trading. So we not only know the past data, we know the order in which the data came. In other words, this program knows if the high comes before the low or the low comes before the high. Basic things like that might seem very simple to you, but they're actually a big cause of making sim trading very, very unreliable. So how we provide our data or our results is from a master program that runs sim accounts on almost any market you can think of. And some of you have been asking for the results for the 6S, and this is it. At the moment in 6S we have 11 markets: crude oil, US dollar index, mini S&P, COMEX gold, heating oil, coffee, natural gas, soybeans, sugar, US T-bonds, and wheat. And after this weekend, you'll be able to ask us for any market you like. I'm going to show you excuse me, a bit of hay fever for a man who's given up smoking. Anyway, these are the markets that we've been trading for you since August, and we can give you the 2018 results. In fact, I'm going to show you the 2015, 2016, 2017, and 2018 results when we start to talk about market profiles. And you can see the results on this from this program for January and February 2019. Some of them are pretty stunning. Crude oil has a margin, I think, of about 3,000 something, so it's sort of 100 and something percent of its margin in 2 months. S&P mini is 6,000, 6,500. So it's at 150% of margin in 2 months. Heating oil, okay, it's dying in the backside now. Coffee, pretty good. And soybeans, not so good. And US T-bonds, not so good. But they will no doubt straighten out. But you can look at the results from 2018 on the CTP program, and this is with it programmed to mimic the 6S signals. To create the 6S signals, what we're doing is we're taking the time cycles and we're cutting them down to the absolute bare fast speed that they can run. So the time cycles that we're using for 6S for you are very, very fast time cycles, and there are multiples of those. So you can see how, given that this is all machine driven, every one of these programs is picking exactly the same entries, risk management profiles and stops for each program. So you look at gold and say, well, there's a $10,000 loss for 2018. What does that tell us? Well, it doesn't tell you a whole lot unless you have a look at the other years before that. And you really need to look at quite an extensive run of data to get a feel. But you can see from here that mini S&P was the absolute boomer in 2018. Well, we all understand that. Crude oil, we know that had a very good year. It had volatility. Coffee, the same. Natural gas, the same. And US T-bonds. So given that all of these markets, and I'm going to show you another 15 or 16 as well, as we move on here, is given that all of these markets are being traded by the machine in exactly the same way, there's absolutely no subjectivity in this at all. It's just the machine is programmed with a set of rules. If you're a bit more switched on, you'd call them algorithms. But to me, they're just a set of rules that we've created, or that I've created over many years. And it's running through these markets, and it's treating them all in exactly the same way. So when you get a bad result like gold, the answer is lack of volatility. What makes these markets really hum? What gives you the big earnings in markets is volatility. Volatility is like waves. It comes into markets and it flows, it ebbs and flows. And when you've got volatility in a market, you get very good results because there's good vertical movement in the charts. And that's the ideal situation. When that volatility dies, profit dies with it. And interestingly, when you look at the bigger picture results, which I'm going to get to very shortly, you can see that at the same time gold has a bad year, copper had a bad year as well. Now, copper and gold have a relationship, as you know. Copper is sometimes a byproduct of gold. They're found together in the mineral strata. Okay, so that's what we've done this year. Neil, I know you're not with us today, but you particularly want to know how the success has gone for January and February, so those are the results. If you want to get a clue of how they're going to be for the year, you can multiply them by 6. That's not actually going to tell you a whole lot, but it's surprising how accurate these numbers are for the major set of data that you see. We ended it in August last year, and then simply multiplied it by the number of months to see what we would get for the whole year, and then compared theoretical against actual. And it's amazing how accurate that is. Okay, this is your big set of numbers. I know there's a lot of them on there, but take some time to look at this, because this is essentially all of the markets that we consider worth trading, and some that we don't consider worth trading. You can see there are some currency futures in here. This is the Aussie dollar, the British pound, Canadian, the loonie, the euro, the yen, and the Swiss franc. And the programs run all of those. I don't think many of those are particularly good markets to trade. The euro is good to trade. The yen is a horror to trade. Swiss franc, if you look at that, you've got this huge year in 2015. I guess that was the year it broke the peg. That's where all the volatility was. But since then, it's been hopeless. Look at these big hits in 2018. Look where all the money's come from. Crude oil, we knew it was good. Hang Seng is absolutely huge. Any of you have access to the Hong Kong futures market? Look at this mini Hang Seng. It has a margin of $2,800. It returned $67,000 last year on one contract. So it's had this burst of volatility, but you can see that all of the equity markets have had that. Here's the Nikkei. This is Nikkei in US dollars, 44-odd thousand. Have a look at the Russell, 21,000. I put a couple of asterisks against this because the Russell 2000 used to trade on ICE, and it recently switched over to the CME. It's a very, very good market to trade equities in, and it's got a much smaller margin than the S&P or the Dow or the Nasdaq. So those of you who are trading equities, don't forget to have a look at the Russell 2000. So here we are. Have a look at the mini Dow, 71,000 for 2018. Now that accounts for commission, doesn't account for slippage, but that accounts for commission. And let's have a look at Nasdaq. Here it is. 75,000. Mini Hang Seng, this is an equities, this is the Hong Kong equities, in fact, in that 67,000. And of course the S&P 72,000. So 2018 was the year of equities. Does that mean they're always going to be good? No. Right here you've now got 15, 16, 17, 18, you have 4 years of data. And you can see how this volatility waxes and wanes. Let's have a look at gold, which I know all of you are very, very interested in. $10,000 loss, only $4,000 the previous year. Go back before that, $26,000 and $14,000. And of course, silver suffers the same fate, but it's certainly a better market. It had a loss in 2018. Look at its previous years, 24, 44, 45. I mean, if we're talking about the sort of parameters of markets and the paradoxes of markets, it's this: how do you find for yourself the right selection of markets? Well, the first thing that's obvious: trade more than one market. You need to trade, if you possibly can, get yourself up to trading 4 or 5 markets. One or more of them will have volatility and will give you outstanding results. One or more of them will be declining in volatility and will be a disappointment. But if you diversified yourself across non-correlated markets, then that will be the answer to it. Last year's previous years does not have any influence on what you're going to get this year. Look at this S&P E-mini, 14,000 in 2016, 2,900 in 2017. I mean, it defies logic, doesn't it? You say, well, that was a good year. What happened there? And you go down to the Nasdaq, 15,000 against 75,000 the next year. You'll get the same thing in the Dow. Here it is, 9,000. Look at these returns: 19,000, 5,000, 9,000. Nothing to get excited about, is there? 71,000 in 2018. So that's the picture of volatility excuse me, coming into the market. So have a really good look at this page, and if you need more time, don't forget this is being recorded. It'll be posted at the website tomorrow. You can go to this page and study it to your heart's content. But previous price results, previous profitability is no guarantee of future profitability. And that's, a statement that all people, anyone talking to you about trading should make to you. Past performance is no guarantee of future profitability. And this layout here of these markets really shows that in a dramatic way. So these are the markets. There's a couple that could go in there. These are all going to be available after this weekend. If you want to trade them, you're going to be able to go to the services, click the services link at the Daniel Code website. If you've got if you're a pro member, if you're paying the $249 subscription, we're going to give you any 2 markets you want of the 6S free of charge, and that's to make your website membership pro package even more attractive than it is, because we're very, very aware that you guys with the pro membership package are really very, very important to us as a business. So we want to make your life better. We'll talk about that as we move along, but all these markets, maybe we should be adding soybean meal and soybean oil. Make sure if you're going to ask us for markets, just have a look at the websites of whatever exchange is hosting them, and make sure there's sufficient volume there. Some of these markets they're listed and people talk about them, they've got very, very limited or very, very small volume. Prince Daniel was talking to me the other day about having a problem. He was trying to pyramid in palladium, and after you've got one position, getting your second and third position, you seem to get a lot of slippage. Well, the reason for that primarily is that on all electric markets, orders are queued in the order in which they're placed. So if you've put in your initial order, you've got a reasonable fill on your first contract. As the day's trading goes on, you're very late in the order entry if you haven't already created your orders, and that's the primary reason why you get slippage. But as well as that, there's not a lot of volume in some of these markets. In fact, some of them are dreadful. Oats, for example, you think that would be a very basic market. There's practically, the volume's in single figures most days. It's ridiculous. But any of these, if you're interested, we'll be happy to do them for you in Success, and we'll show you those arrangements as we move on. In the meantime, there's a lot to think about there, isn't there? What makes these markets come alive and what makes them die? Interesting. Let's have a look at this. This is still talking about this idea for Justin and others of avoiding these one-bar counter trends and avoiding outside bars, which cause so much havoc. This is this recent S&P rally, which has been going all year. It's been enormous. And you can see that it's pretty busy with the buy and sell signals there. Every 4 or 5 days you're getting another signal, sometimes even closer than that. That's in the Success, which is running at a very, very fast speed. Have a look at this. This is the same chart. This is a 3-day chart. In other words, each bar contains 3 trading days. And this is quite different, that in this chart, the trend has been up since the low. All the way, the trend has stayed up on the 3-day chart. So those 1-bar counter trends and those outside bars are having a deleterious, not a great word, deleterious effect on your trading. And one of the things, Justin, we want to look at is taking the trend from the 3-day chart and only taking the signals with the dominant trend. And if we have a counter trend signal, putting on our stops at the place where the counter trend trade would be elected and letting ourselves get stopped out. So that's going to be the next thing coming to you. In case you forget what it's called, it's going to be called Success One Way. It'll be very interesting to see that. We'll get that programmed onto our master program and have a look at those numbers. So these are changes that are coming up this weekend, folks. We've been running the Success Everyday Trading Program for you in test mode for about 5 months or more. Trust you've enjoyed it. A lot of people have written in saying how terrific it is. I'm glad for that. And after this weekend, it's going to be available for individual subscription. Just go to the Daniel Code website, click on the services link, and there'll be a whole new lot of links there for you to sign up to subscribe to Success. The smaller markets are going to be $129 a month. The larger markets are going to be $159 a month. And we've got some interim arrangements on that as well. So after this weekend, you'll be able to subscribe to whatever you want, as many as you want. We're presently what's in the Success package is crude oil, US dollar index, S&P mini, gold, heating oil, coffee, natural gas, soybeans, sugar, and US T-bonds. And a couple of those actually trade on the ICE exchange, which some of you don't have access to that data. But we can create the Success analysis and signals for any futures market you wish, providing we have the data. At present, anything in the CME, NYMEX, COMEX, and Germany's DAX, we can do that. We're going to add the Hong Kong, the mini Hang Seng, shortly. It's just such a terrific market. Any of you who have access to the Hong Kong futures market, which is the Hong Kong Stock Exchange, of course, or have friends who do, bear in mind we're going to be releasing the Success Everyday Trading on the Hang Seng in the next month or so. Again, bear in mind, not all futures have sufficient volume to make them good trading instruments. Any questions on this, and I'm sure you'll have some, you can write to me, email me, jneedham@thedanielcode.com, or terry@support@thedanielcode.com. So if you're subscribed to the Pro membership, that's the $249 package, we are going to give you 2 of our success signals free of charge. You can just, you'll have access to all of them if you're subscribed to the Pro package. You'll have access to all of them for the rest of this month. In that time, in that 2 weeks, we ask that you have a think about what markets you want added to your membership, and we'll be happy to add 2 of those to your membership for free to show our appreciation for your support. Other members, if you're subscribed to a different package, you're most welcome to subscribe to as many Success Markets as you want, or simply to upgrade your DC Membership Pro, and you'll get the 2 complimentary Success Markets of your choice added to your account. Now, despite these fees that we've put on these products being considerably less than market value, they still get very expensive in my view. So there'll certainly be a lot of you people who want to trade more than 2 markets, and 3 or 4 markets, for example, which a lot of you do trade that many or more. That costs us $600, so that's too much. So what we're doing is we've capped it by bringing in a new membership category for you. It's called DC Website Membership Super. It'll be up under the services tag at the Daniel Code website on the weekend. So you'll be able to see it by Monday. And if you want to subscribe to that, you get the works. And that is all of the success signals, regardless of, we have 11 at the moment, we might finish up with 15, 18, 20, 30, who knows which ones we're going to be asked to do, but you finish up with all of the success signals and the TO3 plus signals, and the 4th and 5th seal as well. That's a saving of over $1,000 monthly if you were trading 5 or 6 markets. So we hope you find that's an attractive offer. So that's all going to happen this weekend, folks. For those of you who haven't already been involved with the Daniel Code, we're more than happy for you to have a free trial. Just go to the Daniel Code website, www.thedanielcode.com, and click on the free trial link, and we'll be happy for you to have a 31-day free trial of whatever it is that you want. And this is our compliance page, folks. We always want you to be aware that trading futures is risky. If you don't know what you're doing, you're going to lose your money, and you're going to lose it fast. 90% of new traders lose their bank in the first 3 months. That's the industry statement. I think that that's a gross understatement. I think 99% of traders lose their first bank and a few more in the first 30 days. So for goodness sakes, if you're going to be trading, which I recommend to you, it's the most wonderful occupation in the world, learn how to trade. If you're interested in becoming an elite trader, email me, jneedham@thedanielcode.com, and I'll be happy to send you some material on the Daniel Code tutorials, which we conduct at your convenience through a video link. Go to meetings owned by the same company as this company that's hosting hosting this webinar, and we record all of those. Sessions, put them up on a secure server for you, so you can look at those anytime you like. Akshay says, hi, any likely path updates in S&P 500 and dollar index? Okay, let's have a look, shall we? Get out of this. Finish with this guy for the moment. And there we are. And let's go to our 6 days for S&P. Here it is. This is the SPX. Well, I don't think this is the one we want, but this will tell the story. Let's have a look at the 12 as well very briefly with you, Akshay. That's on gold. SPX, dollar SPX, here we are. Right, well. So, what you've got now is you're back. This is the median. Remember, this is the darker blue line that follows through this dotted line. This is the median. The S&P's now rallied from 212, two Daniel code standard deviations below the mean, and it's back up to one standard deviation above the mean. What happens here? Be very, very careful. Very careful indeed. It's a bit of a conundrum, isn't it? That, I mean, essentially this is what's vital to this is the US economy. And it's doing so well. But this is sort of heading towards a failure pattern at the moment. Let's have a look what we've got on the 6C. It'll be exactly the same, of course. Here it is, and it's done the same thing, incidentally, on the various standard deviations from the mean. Here we are. Let's have a look what happened here. This was the low, and this was the rally high. It's strong. I mean, it's strong, isn't it? Look, it's way up over the. This is the 74% there. It's strong, so it's not running off that cycle. Must be another one. And essentially, what you have in here is you have double tops. Those of you who've done a Daniel Code tutorial will know about Daniel Code hook trades. So this gave you the hook trade here. This is the start of a hook trade. Gets this high. There you are. There was the hook trade. This bar here, there was the sell elected. This bar had the capacity to do incredible damage, and it hasn't. So we just have to wait and see. Actually, stick to the Daniel Code trade signals. They'll have you the right way. Let's see what's happening in the US dollar index. I used to trade the US dollar index. I used to love it. I've sort of gone off it a bit now. What have we got here? This is the 6-day chart. Oh, look at this. You've got a potential hook trade sitting up here. Here's the high. Did it get close enough? My guess is it did. If this next bar turns into a sell, if it elects to sell, that is, it trades below the low of this bar, which is at 96,345. This could be a very big reversal. Same thing. It's very interesting and informative to look at our longer-term charts, actually. But the risk, because there's 6 daily bars in each of these bars, the risk is way outside your risk parameters. So you need to look at the daily bars to see what's happening. In fact, we have a sell. We have an inside bar sell, the daily inside bar sell for the US dollar index for today in our TO3 plus packet. Okay, so there we are, folks. That's about time. I hope you found this informative. I find I can get a lot by looking at those, all of those numbers, and I've probably got a bigger version of it sitting here for you. Here it is. And here's T-bonds. Here's the rest of the big picture. We're going to lose a couple. Here's your top half of them. Yeah, so I get a terrific lot of insight from this, but there is no prediction coming from any of these markets really. You could look, for example, at the euro and say, look, this thing's been solid all the way through 57, 16, 10, 10. It's a pretty solid market, but you could have said the same thing about gold after 15 and 16 to find this big drop down in 17. But anyway, the picture at the moment, folks, is that it's the equities are roaring. You must make sure you've got a decent exposure to them. So thank you for being with us, folks. It's Friday at 11:33 p.m. In the land down under, which means it's time to head to the swimming pool and the Bloody Marys. I hope your Friday is just as good as mine. And thanks for being with us. Good, Hank. Good to have you. Mike, you too, mate. Good to have you. Mike, anytime you want to talk to me, just send me an email. Same for you, John Lisserman or Hank. Anyone who's done a tutorial. Need me for anything, shoot an email. I'll be happy to make an appointment to talk with you. All the best, fellas. Bye-bye for now.